Now we have the big two from TCS, Rajesh Gopinathan and Samir Seksaria. Let me take it from my macro angle. I cover economics, and what the IMF tells us, 21 growth was 6% for global economy, 22 was 3.7, and 23 is going to be 2.1. I mean, it's huge. I mean, just what red flags in your world?
See, our business is on a very focused customer set, both from a market perspective as well as from a client universe perspective. So the way I would look at it is, rather than try to parse the overall big global economy picture, if you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today compared to 5 years ago or 10 years ago. So balance sheet repair has happened. The EC money actually resulted in a fairly good disciplined execution on that side. The financial markets, of course, react to the repricing of the asset on terms of where the interest rate is. But when we are looking at actual individual companies, they are more impacted by the supply chain issues, which have kind of played out through the year. They are in fact on the absolutely on the getting mended. Geopolitical issues in Europe will continue to have an impact, especially for that market and for some of the long supply chain kind of industries. But others in UK, in US, they're in a much more stable situation. So our own view is that there will be some impact of the overall negative commentary that is there in decision making. But when we take, let's say, a 6-month view or a 12-month view, we are much more positive, because we believe that our client universe, their underlying business is in good shape. And that is what is driving our positive outlook on our business compared to where the overall economic commentary is.
Okay. Samir, I wanted to ask you about the margins. It's impressive that at a time like this, you are, not only delivered better margins than quarter ago, you're promising to exit at 25%. How are you so sure, and what led to that improvement?
Okay, fair. So I think this is still an aspiration, but we have put it out at the beginning of the year when we gave our full quarter increments, and we came in at 23.4. We said we want to exit this year at 25, and structurally we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. Two specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year, and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
And there is still space over there?
There will be operational levers from an execution rigor perspective, which always will be there. Fees to external consultants still provides us an opportunity. There will always be puts and takes in terms of how it would set up. Second factor is currency has been beneficial to us, and at that also we have been calling it out.
That may not be there this year, we are told.
Let's hope.
Rajesh, just talking about Q3, what explains why you didn't see higher furloughs when your peers did and called out specifically?
I think it's a question of, it's been quite a few years also, Rima. So to exactly, and to say that it is higher or lower, the variations are not that material to be a commentary item. So what we have said is that it is regular, it is coming from the same. So we have more than the volume. We have put our commentary based on where is it coming from, which markets is it coming from, which industries is it coming from. Are we seeing something completely surprising? Some industry that never used to do furlough, standing up and talking about furlough. So none of that has happened. The actual volumes, it's not that material to be, the variation is not material enough to be called out.
Samir, you've announced a special dividend, as in the board has announced a special dividend of 67 rupees. Does this rule out a potential buyback? Because the window for the next board, a buyback announcement, is in the next couple of months. So should we expect no buyback from TCS?
So, see, our capital allocation policy has been consistent.
Yes.
And if you look at technically, as the regulations currently stand, we couldn't have done a buyback in
Correct.
this year. We completed our last buyback
In March.
because it has to, at the end of March. So, if we had to do something in this year, the buyback option wasn't available. On an ongoing basis, we look at a combination of various measures of distributing cash flow, and it could be both dividends as
So
well
a
as
buyback could be on the cards in Q1 FY24 when you are eligible?
That's always an option available.
Okay, that's the nearest you will come, is it? Okay, Rajesh, I'll tell you, from what the investors took home, the two big fears are that your TCV, your total contract value, was only 3% higher. Last year, it was 10% higher. Your total workforce is actually a few thousand lower. Both these look like 23 is going to be difficult.
Lata, actually, I should have had that number, but our TCV is now, earlier it used to be in the 6.5 billion range. Now it is consistently staying in the 7 to 9 billion range.
Yes.
So on an average, if you compare it, because TCV by nature is volatile. So on an average, we are not, we are in quite a good shape. And we have always said that the multi-billion-dollar deals are one-offs, and that needs to be, you cannot predict as to when it will come. So overall TCV trend lines, and so there are three layers to it, right? Overall pipeline, qualified pipeline, and then the TCV. Everything is in a fairly good shape. The place where there is weakness, we call that out in Europe, where qualified pipeline continues to grow, but the actual decision making and closure on the contract side is getting delayed. And there we see a definite decline, which is where our commentary on Europe is a bit much weaker than what it is about the rest of it. Whereas if you take US or UK, deal closures are continuing at a fairly good clip. In fact, UK had specifically called out, though the overall operating environment is challenged, actual decision making is very positive, and people are moving forward with transformative projects.
Rajesh, you are confident about a double-digit growth this year, FY23. Are you as confident? How are you thinking about double-digit growth for FY24?
This is a milestone quarter for me. This is my 40th quarterly.
Congratulations.
So batting back this question again and again. So keep that in here, that we don't want to get drawn into making a specific comment. But otherwise, as I said, these 2 years have been a fairly strong growth years. The next year is like more a balanced year, a consolidation year, both on the revenue side as well as on the overall profitability side. The perspectives are very different depending on the markets. And I think the most important one is that we have a divergence in US between what the larger commentary is and what our own perspective is. In Europe, we are fully aligned to where the macro commentary. And UK, we are executing totally differently. In UK, we are now by far the largest technology services provider. So significant market share gains, significant growth, very clearly highly differentiated positioning. All of that is playing out. So overall, it's a good, I just used this analogy earlier, that it's a good test pitch.
Okay.
There's
so
something
only
in
the
it for everyone.
15% which comes from Europe, you say, is under threat.
Absolutely, where there is clear A, and another 15-20% which is from all the other markets, about 15%, they are very volatile to call, so they are difficult to call in any given year. And the 15% Europe, which has been a big growth driver for us till last year, that is off the boil and likely to remain soft in the near future.
Rajesh, on the conference call yesterday, you said that you have won 20 optimization-focused large deals in the first 9 months of this year, versus 16 in the similar period of the previous year. So 20 cost optimization deals versus 16. What would that same number be for growth and transformation where we are seeing some slowness?
I don't off the have it, which is one of the reasons why I hesitate to give these numbers, but I don't have the cut on the other side.
But is it significantly lower?
So on a quarter-on-quarter basis, our deals have been equal. That is between Q2 to Q3.
Okay.
So
on GNT?
No, overall. So to that extent, yes, GNT will be. But on that, this thing, on a larger one, larger period, I don't know the number.
And if one big geography, that's Europe, which is about 15% of your revenues, is challenged, is it not fair to assume that FY24 growth could be lower than FY23? Not
It's,
getting into
I
numbers,
mean,
but
see, that's the realm
The
for the
delta.
people who are going to make a bet on the
Forecast.
stock. But for us, it's more about playing the market as it is. So, as I said, our stance in North America is very forward.
sure.
In our stance in UK is very forward. Our stance in Europe is a bit more on the back foot, and we are playing it for individual ones and twos, and scoring where we can.
Has pricing played out, Samir, the way you anticipated, the increase in pricing?
Like I called out, we are getting pricing improvements on a case-by-case basis, but given the inflation which the world has gone through, overall the expectation would have been that as a CFO at least, we would have seen much higher uptick. That is yet to come, and pricing reflects also over the quarters. It doesn't reflect in one quarter, but realization definitely has seen an uptick sequentially as well as year on year.
So it's played out as per your expectation.
Realization uptick has been there. Revenue productivity has been there.
Would it be more fair for you to say that the TCV range should be 7 to 8 rather than 7 to 9? Do you have that much skepticism over 24?
No.
So you
I don't- I would
could get
say
TCVs above 8.
Absolutely, absolutely. And this 7.8 also, we have been on average above 8 only.
Yes.
So I don't think that need to reduce the TCV range or to narrow it down. There is enough. Again, as I said, the qualified pipeline, which is the one step before that,
yes.
is still continuing to grow, right? In absolute terms, it is continuing to grow. So there is no reason to assume. It is the decision making that is getting delayed. We are not hearing of project cancellations. We are not seeing people stepping back and saying that, guys, put a hold on everything. It's more of the delay in committing and starting of new programs.
So the
We are
7
being
to,
warned about
Yes,
time, so
sorry.
you ask your best question now.
No, $7 to $9 billion of a quarterly deal win run rate stays for FY24 as well, right?
I think it's a fair one, absolutely.
Okay. Does 26% now become a little more away from your reach margins?
First target get to 25% and then get
25 you
to
have
nearer
promised.
to
25 you're saying is in the current quarter.
we are looking forward to 25% exit in this year, and then we'll try to get to 26 as soon as possible.